editor of Material Profits. So Sarah, what's really driven up the new record today in oil prices? Is it really supply-demand dynamics or the renewed weakness of the dollar?
It's the renewed weakness in the dollar, hands down. There's no way in the world that the supply and demand dynamics that we're currently seeing in the marketplace can support oil prices without a weak dollar.
So what does that mean? If the dollar finds renewed strength, just like it did in the earlier part of this week, it's going to happen to oil prices. It's just going to fall?
Yeah, I think it should. We've seen some commodities fluctuate when the dollar gains some strength. A 3% rise in the dollar index means close to a 10% drop across all the commodities. The inverse, of course, is also true, as we're starting to see with the dollar weakness again. We saw oil prices jump 2%. So I do think if we see some dollar strength, you're going to see not only oil, but commodities across the board start to decline just a little bit.
Just a little bit, but not a lot. How come?
Well, we do have some supply and demand dynamics that are underlying this price rise. We have some Nigerian militants still affecting oil production. We're seeing some big non-OPEC producers starting to decline. Russia has said for the first time in 10 years that its production declined. We've got some severe problems in Mexico. And we've also seen some demand ramp up just a little bit in the U.S. This is the second week in a row that we've seen stocks decline.
And what about for gasoline? I mean, how big an issue are falling U.S. gas stockpiles? So are the summer stockpiles really at a risk given the slowing domestic economy?
Not really too much. We're actually still relatively okay on gasoline demand. We're lower, gasoline supply. Our demand is lower than it was last year, so we do have more supply to play around with. That said, if demand does drop, I'm not sure how much of a drop in prices we are going to see with sustained high oil prices, because it is high oil prices that are really affecting the price of gasoline right now as well.
What about when it comes to the refining rates? What do you think is the biggest driver in the low refining rates that we're seeing? Is it really the falling margins or the prospects for a drop in demand later this year?
I think it's a drop in demand. All producers across the board are relatively reluctant to start producing more supply if they believe that demand is going to drop and therefore prices will drop. And they're also being strapped a little bit by the high price of oil. But I think, again, it is going to be the shaky demand aspect of gasoline prices, or excuse me.
So I guess that means margins can fall much further from here on out.
Yeah, I definitely think that's possible, and you should definitely keep an eye on the large producers such as Chevron or ConocoPhillips or ExxonMobil.
Now, what about the agricultural commodities? Are they driven to by the falling dollar, or is there really supply and demand dynamics working in there to support the record rallies in the likes of corn, wheat, and sugar?
Well, agriculture is one of the commodity sectors that I do see with supply and demand dynamics actually affecting the prices. We've seen some food riots across the world based on supply issues and also based on price issues. So it's a double-edged sword right here. We do see the dollar affecting prices, but it's much more of a supply and demand issue than it is a dollar weakness issue at this point.
So where's the biggest shortage? Is it really in rice, because we're having riots all around the world because of this food shortage?
Well, anything you can use to make bread right now, particularly when you're talking about places in India and places in Egypt, we're seeing some severe shortages in bread, some higher costs in bread. So that means corn, that means wheat, and that can also mean rice as well.
So between hard commodities and the soft commodities complex, which do you think will see better returns for investors this year?
It actually depends on the strength of the dollar. If we do see a little bit of a rebound in the dollar, I think you have to go with agricultural commodities because of that supply and demand dynamics. However, if we do have a continued weakening dollar, you have to take a look at gold and silver and even perhaps oil as more of a hedge against that falling dollar.
Yeah, now that you mentioned gold and silver, what sort of prices do we see if the dollar continues to fall, and what are the assumptions that the dollar continues to recover?
Well, if the dollar continues to recover, you're looking at a support point, particularly for gold at about $900 an ounce. We've seen some support there before. For silver, it's around about $17 an ounce. The upside is really limited only by how far the dollar can fall. So you can't really put a top on precious metals right now, particularly when folks are using it as a strong hedge against that falling dollar and as a protection for their equities portfolio.
So as a hedge against inflation, where do we go more? Do we tend more towards the gold or silver? What is your choice?
Well, it depends on how much you want to spend. In comparing the two ETFs, which I think is the easiest way to hedge your portfolio using precious metals, the silver ETF is definitely a lot more economical. But I think both have the potential to secure some of your gains that you may have already made in your portfolio and protect against some losses as well. Either are a good option. Just as a matter of price, I would probably go with the silver ETF right now.
As we're talking about precious metals, what is your opinion when it comes to platinum and palladium? Are you as bullish?
I definitely think the whole complex is on its way up should the dollar continue to fall. I would definitely still put more emphasis on the gold and silver side of the play, though.
Great. Well, it's good to talk to you. Thank you so much for joining us, Sarah. You know, Greg, it's really interesting. I know you've